This is the 10-Minute Contrarian Podcast. This is VP. We are a solutions-based podcast, diving into the world of contrarian investing and alternative finance. You can find us hosted on the No Nonsense Forex YouTube channel, NoNonsenseForex.com, and podcast players everywhere. Episode 151 is brought to us by Bybit. We had a slow week of trading this past week, but anybody who trades can tell you that you know what that means. We are setting up for what's going to be a pretty big run. So if you haven't signed up yet, now would be a good time to do it. Get yourself in there, get yourself familiar with the platform, and get ready for that next big run so you can catch it. The way you do this is you go down to the show notes, you click the link, that takes you to my blog. I always try to keep you updated as much as I can on that blog and what's going on with Bybit. But on that blog at the very bottom is my affiliate link. If you click that, get signed up, you get a cashback bonus. And then you are officially plugged into the Bybit ecosystem for life, which is a great place to be. Because as millions of people across the world can already tell you, with Bybit membership has its rewards. It is the 10-Minute Contrarian Podcast. And for those of you who have been with me on this podcast since the start, or for a while, you probably have noticed something that we will talk about certain things on this show, and then almost immediately they will start to come around in real life. Or at least people will slowly start to notice the same things that we have noticed early on. A good one, I think, is the population episode I did a few weeks ago. I was just talking to somebody on Twitter about this. How it's almost like if you buy a yellow car. You didn't really see yellow cars on the road hardly at all, so that's why you bought a yellow one. But then once you buy it, you start noticing every single yellow car on the road. It's kind of what's going on here. I think after that episode, at least from on my end, I'm seeing all sorts of articles and scare stories about population decline now. And I was not seeing it before, which was really the reason I wanted to broadcast those ideas to you. Now, this doesn't happen all the time, of course, but one other thing that I have noticed really play out exactly the way that at least I thought it was going to play out, up until right now, at least, is what's going on with interest rates in the United States. Now, if you go back to the very first episode we did this year, it was called the Big Macro Episode 2024. I included a chart, and it's a very telling chart, and it's a chart I've given you guys in the past, and I'm going to go ahead and give it to you again because I don't know who's new, and I guess just for convenience sake, it's nice to just pull this up and look at it when you want. But it's going to be a chart from the St. Louis Fed showing interest rates over the years, how they've risen and flattened and fallen, and when recessions come as a result of these moves. And you will notice, since the 80s, when inflation was out of control and things were just wild, and like you can't even count that, what was going on in the late 70s and early 80s, you will notice that every time interest rates go up, they will flatline, and then they will drop. And right there during the drop, maybe anywhere from 2 to 6 months after they start falling, is when you typically get a recession. Actually, not even typically, all the time, when you see the rise, then the flattening, then the fall. And my grandiose prediction in that same episode was that the Fed, even though they're not supposed to be a political animal, they are a political animal. They do answer to Congress. And what we should see is this exact same phenomenon play out. And it should line up right in time for the either inauguration of the new president or a continuation of Biden's second term. And this is exactly what they want, because it really is a win-win for them. Either Biden's already in and you can just go ahead and hit the release valve and it's just going to suck. And then the Democrats have 4 years to figure out, how they're going to try to patch this up or try to explain it to the American people that it wasn't their fault. Or Trump gets in and then you immediately hit the release valve, and then most people are too dumb to understand the correlation, and they'll just simply blame it on the new administration. And if you go pull that chart up right now, you will see we are in that flattening phase, which means interest rates have remained untouched. And there's so much talk that last year they said they were going to lower the interest rate 16 times. I'm like, what? No, how? Impossible. Under. And of course, it didn't happen at all in 2024. It hasn't yet. And then not even a month ago, they said that for the remainder of 2024, they planned on lowering interest rates 3 more times. And depending on when they do that, if they wait until Q4 or close to it to start doing that, that would actually line up pretty perfectly with my prediction. But even still, I just feel like that's not going to happen either. I mean, first off, the Fed has said so many things that they haven't done. It's like, what's the harm in just saying a bunch of nonsense this time around too? Like, who cares? There are no consequences for these actions on their end. You know, the market's probably going to freak out, but that's just what the market does. But again, it would make sense for a lot of reasons too. In particular, you guys know, well, if you don't, I'll give you a really brief rundown here. The Fed is trying to control inflation because, again, they are not supposed to be a political animal, but they are. And inflation is the one thing that your general public hates the most. It is a very nonpartisan issue. It's the one thing that we can actually all agree on. That prices for all the things we pay for going up is generally really bad. I guess rich people wouldn't care as much, like the truly rich, not the pretend rich, because the market typically goes up during this time as well, which is overall good for them. But the vast majority of your voter base is going to get pretty angry if they're already living paycheck to paycheck or close to it, and the price of everything they buy pretty much gets higher, and in some cases a lot higher. And traditionally, you would do that by raising rates. Now, as we have seen, raising rates has consequences, a lot of consequences. Now, banks in particular really hate this because banks make a lot of their money by lending money to other people. And when rates go up, this becomes a lot more expensive to do, sometimes to the point to where banks just stop lending altogether. And you might be like, well, boo-hoo, they're banks, who cares? Well, no, this has a ripple effect on pretty much the entire economy. You know, it's hard to grow when nobody's borrowing money and using that money to put into, startups and stock buybacks and things like that. And there's a whole host of other reasons that I'm either forgetting or just don't have time to explain here. But these are really the only choices the Fed has. And we've been saying this, and people way smarter than me in the macro world have been saying this for years now, that the Fed is completely out of options. There are no options to make this better. The best thing they can do for themselves, and only themselves and whatever political affiliation they are tied to, is to keep kicking the can down the road. We've seen that's exactly what they've been doing. Problem is, at some point, and we are arriving very close to that point, you run out of road. And the end of that road is getting dangerously closer. All seems to line up perfectly for the very end of this year. In the United States, elections are in November. The president gets sworn in January. And I'm just saying, I don't know if I'm going to hit this prediction or not. I don't win a prize for it, but just so everybody knows, it looks like everything is lining up for the end of this year. Because there's really no way to fix this. People are like, well, let's just print more money. Well, that's how we got here in the first place. That's what caused the inflation that caused the Fed to raise rates. And by the way, if they do that, and again, a lot of people are saying that this is going to happen regardless. You're going to be really, really glad you held on to your gold and your Bitcoin. But let's not get too off track here. One thing I want to mention as just an aside, but a potentially important aside, is if we see the chairman of the Fed, Jerome Powell, retire, this could be quite significant. Now, if Donald Trump wins the presidency, he's probably going to fire Powell anyway. So not on that, or not as a precursor to the inevitability of something like that. But if he just up and retires on his own, I think that's going to be a huge sign. And you better be fully prepared for what is probably going to happen next. We've spoken on here before. The one thing we can pretty much ascertain about Powell is he does really care about his legacy. He wants to be the guy who came in and fixed all of this. But it's looking more and more like that's never going to happen. Again, it's an inevitability. The Fed is out of options. And in the annals of history, you don't really see the asterisks, which means if Powell were to retire and then his successor were to come in, and then right when they do, the bottom just falls out of it, history is going to remember that person for being the Fed chair while all of this was falling apart. Less so Jerome Powell. So I'm just putting it out there. If you see him retire a bit prematurely, I would maybe not panic. We shouldn't panic here. We should be fully prepared. But if you're not fully prepared, you're going to be on the clock. So for those of you who need to light a fire under your ass to do anything, let that be your fire. But anyway, back to the overall theme and title of this episode. There is talk now, not just on like CNBC and Bloomberg, because I would generally ignore that, but with some pretty smart people who I've followed over the years, saying that there's a possibility that the Fed is going to raise interest rates. After all this talk of lowering interest rates, now the Fed is going to do a complete face turn and start raising them again. I don't know. Well, the main reason they're giving for this is that, again, getting inflation down is paramount. And they've been saying this whole time they want to get it back down in the United States to a 2% rate. And they just don't think they're going to be able to do that. We're currently sitting at about 3.5%. But in the United States, at least, a jump from 2% to 3% is very noticeable still. And the reason you would lower interest rates is to boost your economy. It would be to boost the market. And the markets have done nothing but stagnate or go up over the past year. Now, we did have a bit of a drop last month, but it just turned out, like we were saying, to be nothing more than a bullish retracement. And now we're back up again. So there is no real reason to lower rates. Now, will there be in the future? Will there be at some point this year? Maybe. But that's why you would do it. And then, as we've seen with that chart, when this happens, you can typically expect a recession to be right around the corner. But now let's not forget, it's not the lowering of rates that causes a recession. If anything, that's supposed to be the opposite. You lower rates to goose the market and to make it go higher and to make the cost of money cheaper so more people can borrow and put it back into the economy. Not the other way around. So why does this lowering of interest rates, after a long flat period of doing nothing, end up being so good at timing the last 4 recessions we have seen in the United States? Now, some of you know the answer, but some of you don't, and that's okay. So I'll go ahead and tell you now, it is not the drop in interest rates which causes the recession, even though it looks like that's exactly what's happening on that chart. No, it's actually the higher interest rates that cause the recession. But it's not the high interest rates themselves, or else as soon as you saw that sharp incline, people would panic and say, oh, this is terrible, and then everything would fall apart. That's not how it works. It's a high interest rate environment. This environment needs time to sink in and really do its damage. So therefore, what you're actually seeing is a sharp increase in interest rates and then a lag effect. And then towards the end of this lag effect is actually when you see the recession happen. It has just so happened to coincide with the lowering of interest rates these past 4 times we've seen it. So really the point of this entire episode is for me to tell you that, in my opinion, I don't think it really matters if rates go up or down from here. The lag effect from the increase in rates is still going to be the lag effect. And when the market decides to finally tap out is really anybody's guess, but I just know historically that it would line up pretty well with the end of 2024. Give or take a few months on either side. And again, as well, in the past, the Fed was able to do their magic and goose the economy into recovery like we saw during 2020. But because of mistakes like that and all the mistakes they have made leading up until now, they can no longer do that. You might see them do something dramatic, which would cause a temporary rise because, like we said before too, Wall Street is going to Wall Street and they're going to react the way they react. But I and many people smarter than me do believe that it is an inevitability at this point. They are out of options. They are running out of road to kick the can down. And it is all lining up for one big disastrous recession. And although timing is a fool's errand, I can at least just report what I see, and early 2025 would seem to be a reasonable time, based on all the factors I have presented to you. So that's pretty much the end of my prediction and why I feel this way. But oddly enough, as I was pretty much compiling all the notes, here comes the one guy who I mentioned probably too often on this podcast. You probably guessed it. That's Peter Zeihan. Comes out, and if you guys don't know, he usually puts out a very short video every weekday talking about whatever, and this time it just happened to be about interest rates, and he has what I think is a wild prediction that we are, from this point on, going to see nothing but higher interest rates going forward, and not just for the rest of this year, for like the next 5 to 10 years. I couldn't imagine an environment like that. And if we do have a recession, why on earth would the Fed do that? That is so counterintuitive. But he does explain it. He explains it fairly well, and I will put this YouTube video down below in the show notes as well if you want to go there right after here, just so you can get a different perspective. Again, I don't agree with it, but he does walk us through it. Now, prediction-wise, like I said before, he has been really great when he stays in his wheelhouse. To me, finance has not typically been his wheelhouse. He was the guy who said back when Bitcoin was at 16.5 that Bitcoin was going all the way down to zero. Now, you can have an opinion like that, but he never walked us through that process. Partially because nobody pressed him on it. Mark Moss had the chance, Joe Rogan had the chance. Neither one of them did it. That was disappointing. If it was me, I would have said, "Okay, walk me through it. How does this happen? How do all of these hodlers who are already millionaires in the fiat world collectively dump their positions and get this thing down to zero? In what universe does that even happen?" But I digress, right? Just another perspective. Let's just at least put it out there. So if it does happen, at least we have something on the record. But a wild prediction nonetheless. So I just want to include that for your listening pleasure after you are finished with this podcast episode. But this podcast episode has come to an end. Thank you for hanging out and talking macro with me. I always enjoy it. I used to hate it. Now I enjoy it, oddly enough. But I think regardless of if rates go higher or lower, that it's just not going to matter, because in the past, it just hasn't mattered either. What's done is done. And if history is any indicator, and it often is, then the inevitable is the inevitable. And you sure as hell better be ready for it. And we will continue to bring you all the information we can on financial prepping on this podcast, because if the inevitable is the inevitable and it's going to happen anyway, it's okay to prepare and be crazy. Because when it all goes down, you're going to be really glad you were early.